Over the past year, the S&P 500 is down a little over 8%, but the market saw a really nice bounce back in the month of January. We can see it's up 7.76% over the past month, but even with that bounce back, we still have quite a few stocks that are trading near their 52-week low. So in this video, we're going to be looking at 3 different dividend stocks that are trading very close to their 52-week low. So let's go ahead and jump into it. And the first dividend stock that we're going to be looking at is a company that's been on my watch list for a while, and that is Kroger, stock ticker KR. Currently trading at $44.36 per share. Now, over the past year, it has actually outperformed the market. It's only down a little under 1%. And we can see over the past month, they're actually down about 3%, but they are getting pretty close to that 52-week low of $41.82. So let's go ahead and jump into my stock analysis spreadsheet. And you can see we're going to be looking at 4 different valuations. We'll look at Graham's valuation, a discounted cash flow, a multiples valuation, and a dividend discount model. And all of this will roll into my output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, you can head over to my Patreon page at the link in the description. But okay, let's go ahead and come up here and plug in KR and hit enter. And you can see all this data is going to automatically load in. Now we're currently looking at a 1,000-day change, so we can see there has been a huge run up over the past few years in their share price. Let's go ahead and zoom in a little bit more and look at a 500-day change chart. And this is where you can see there was a pretty large decline in the share price over the past year. If we come over here and look at the dividend data, we can see they're currently paying out $1.04 per share, which only gives them a dividend yield of 2.34%. So not a very high starting dividend yield, but a nice low payout ratio at just 27.5%. So let's go ahead and jump back over to Seeking Alpha and jump into that dividend data a little bit more. I typically like to look at the dividend history. And here we can see this is a company that's been increasing the amount they pay in dividends for 16 consecutive years. So that is a very good sign. Let's go ahead and look at the 10-year dividend growth. We can see 10 years ago, they were paying about 8 cents per share quarterly. Jump forward to now, and that's more than tripled. They are now paying out 26 cents per share quarterly. So while the starting dividend yield isn't very high, it's evident that they have really good dividend growth, which to me is a sign of a very healthy company, especially when you have a nice low payout ratio at around 27.5%. Analysts currently have a target price for this company, $52.53. Institutional ownership pretty high at around 81.3%. Now, something I don't typically point out is the volatility, but we do need to take note of one thing. And if we jump over to this article on Seeking Alpha, we can see there's a potential merger with Albertsons company. And whether this goes through or not, I'm not 100% sure at this time, but you do need to keep that in mind that there may be a little more volatility with this company at this time due to that potential merger. Now, the last thing we'll look at is the beta, and you can see it has a beta of 0.49, so you shouldn't technically see a whole lot of volatility with the company, but like I said, in short term, you might see a little bit more than normal. But let's go ahead and jump to our first valuation, which will be Graham's valuation. Here's the formula Benjamin Graham lays out for us to calculate intrinsic value. So when we plug in all these different variables like earnings per share, our growth rate projections, and the current yield on AAA corporate bonds, we come to an intrinsic value of $56.68 per share, a decent bit higher than that current trading price. But let's go ahead and jump over to our discounted cash flow analysis. And in order to perform this model, we need to project a growth rate to the future free cash flows for the company. So you can see I plugged in the historical free cash flow for the company so we can see our year-over-year growth rates. And had a really good average year-over-year growth rate of a little over 25%. So that's phenomenal free cash flow growth. I definitely don't suspect to see it that high in the future. I'm projecting a growth rate of about 6%, which is actually pretty solid for this company. So I projected that 6% growth rate to the future free cash flows, found the present value of those future free cash flows and added them together here, added the company's cash and subtracted out their total debt to get the equity value. And after dividing by the shares outstanding, again, we come to a discounted cash flow price per share of $55.56, pretty close to what we got for Graham's valuation, as you can see right here. Now, jumping over to our multiples valuation, the idea behind this is we should be able to value a company based on how the market is valuing companies that are similar in structure. So you can see the companies we're using right here as the comparables. We're taking their stock price, dividing by the earnings per share to get that price to earnings multiple. We then take the average price to earnings multiple for these companies, which is 18.76, multiply it by Kroger's earnings per share, and we come to an intrinsic value of $59.86. So we can see the average price to earnings again, 18.76 for these comparable companies. If we jump over to our stock screener, we can see for Kroger, it's currently sitting at 13.91. So it would slightly appear that they may be undervalued according to the multiples valuation. But one of my favorite valuation models for dividend growth companies is always going to be the dividend discount model because it values a company based on how much they're growing their dividend and how much they're currently paying out. So what I've done is I plugged in the quarterly dividend payouts over the last few years so we can see how much they pay out each year. And this allows us to see year-over-year growth rates for Kroger, and it's been really good of 14.29%, 12.5, 16.67, and most recently 23.81. That is phenomenal dividend growth over that time period. That's an average growth rate of 16.82. So moving forward, I'm projecting a dividend growth rate of around 7%, a discount rate of 9%, which gives us a dividend discount model price per share of $55.64. Now, one thing you always need to do whenever you project a high growth rate for your dividend discount models, you want to check two things. The first thing you should check is something we've already talked about, and that's the payout ratio. You want to see a nice low payout ratio so you know the company has plenty of room to continue to grow its dividends, which in this case it clearly does. And we also want to see that we have projected growing free cash flow, and again, we have that here. So I do think that dividend growth rate will be sustainable moving forward. So when we jump over to our output tab, we can see our four valuations: grams at 56, multiples at 59.8, discounted cash flow at 55, and dividend discount model at 55. And so when we average all four of these together, we come to an intrinsic value of $56.93 per share. All four of these valuations are surprisingly very close to each other. It's not very often that you're actually going to see that, but again, intrinsic value of $56.93. Now, as a value dividend investor, we do always want to apply a margin of safety. So let's say in this case, I apply a 20% margin of safety. Based upon that, the acceptable buy price is around $45.55, meaning now may be a good time to consider adding this to your portfolio. If you were to apply a 30% margin of safety, your acceptable buy price is around $39.85, meaning it's not quite in that range yet. Keep in mind there is still the threat of a looming recession with this company, which could potentially hurt the short-term gains that we could see. This is definitely a company I believe in long-term, and it's on my watch list, and I may consider adding it to my portfolio here in the near future. The second dividend stock that we are going to be looking at near a 52-week low is Medical Properties Trust, stock ticker MPW, currently trading at $12.44 per share. We can see over the past year, they are down a staggering 43.89%. Now, this is actually a company that I recently added to my dividend portfolio. If we jump over to my Do-It-Yourself Investor Toolkit and come to my dividend dashboard, I'll go ahead and zoom in just a little bit. But if you come over here, you can see, again, this is a new position, but it's going to be paying me about $92.80 a year in dividend income. But let's go ahead and jump back over to Seeking Alpha. We can see over the past month, they have had a little bit of an increase, but they are still pretty close to that 52-week low. So let's go ahead and jump over to my real estate investment trust valuation spreadsheet. And again, it's a similar spreadsheet, but we have different valuation methods, as you can see right here. So let's go ahead and jump over to my stock screener. I'll come up here and plug in the ticker for Medical Properties Trust and hit enter, and you can see all this data will automatically load in. Now, we're currently looking at a 500-day change, so again, you can see a pretty drastic decrease in the share price. If we come over here, we can see they're currently paying $1.16 per share, which gives them a very high starting dividend yield of 9.33%. Let's go ahead and jump over to Seeking Alpha again and dig into that just a little bit more. And you can see I'm looking at the dividend history page, and they've been increasing the amount they pay in dividends for 10 consecutive years. For a real estate investment trust, that's pretty solid. We can see back in 2013, they were paying out about 20 cents per share quarterly. Jump forward to now, that is now 29 cents per share every single quarter. So pretty decent dividend growth for a real estate investment trust. Now, the payout ratio is showing about 55.2%, but that's not really the best way to judge for a real estate investment trust how safe their dividend is. But that's something we'll come back and talk about later in the video. If we come down here, we can see analysts currently have a target price of $15.38, institutional ownership around 84.1, and a beta of 0.9. So the volatility should be pretty close to that of the market. But let's go ahead and jump forward, and we'll look at our first valuation, which is going to be our price to AFFO multiples valuation. And similar to the multiples valuation we looked at with Kroger, but instead we are looking at the price to AFFO multiple. So you can see the comparable companies we're taking right here. We're getting their price to AFFO, taking the average and multiplying that by MPW's price to AFFO, and that gives us an intrinsic value of $18.68 per share, a decent bit higher than that current trading price of $12.44. Now, one of my favorite ways to value this is going to be a historical price to FFO. And essentially, it's kind of similar to what we just look at, but it's going to look at where the company has traded at historically compared to where it is now. So again, I'll go ahead and zoom out a little bit, but I plugged in the historical price per share for the company. We also have the historical funds from operation per share. So that gives us our historical price to FFO data right here. And we can see where they're currently at right here. So currently, the historical price to FFO for the trailing 12 months is 6.53, but on average over the last 10 years, it's been at 14.35, and it's kind of charted out right here. So technically, where they're currently at is going to be a little bit below off this chart. So to me, that's a huge indicator that this company is currently undervalued. But let's go ahead and jump forward and look at our dividend discount model. And again, you're familiar with this. we can come over here and see the FFO payout ratio. This is a much better way to judge the safety of real estate investment trust's dividend, and it's currently sitting at 64.93, so I do think this is a safe dividend paying company. But again, I plugged in the quarterly dividend payouts so we can see how much they pay out each year, and we can see our dividend growth year over year of 4%, 3.85, 3.7, and 3.57. I think gradually this dividend growth rate will start to decrease. That's why I'm projecting a growth rate of about 2%, but a discount rate of 8.5%, and we come to a dividend discount model price per share of $18.20. Again, quite a bit higher than that current trading price for the company. Now, another way to value real estate investment trusts is going to be net asset value, but I typically don't perform this valuation because it's so sensitive to the different variables that we plug in to our formula. But essentially, if you want to download the spreadsheet and mess with this, you can use a sensitivity analysis to see, based on the cap rate applied and next year's net operating income, what a fair value is. But when we jump over to our output tab, we can see the two valuations we used, AFFO at 18 and dividend discount model 18. Also keep in mind, while the historical price to FFO doesn't give us a fair value, we did decide it was slightly undervalued compared to these other valuations, but that gives us an intrinsic value of $18.44 per share. Current trading price is around $12.44, so if we apply a 20% margin of safety, we come to an acceptable buy price of $14.75. With a 30% margin of safety, an acceptable buy price of $12.91, meaning now may be a good time to consider adding this to your portfolio. And again, that's exactly what I did. I recently added this to my portfolio over the past few weeks. But let's go ahead and jump forward and look at our last company. And the last dividend company that is near a 52-week low that we're going to look at is CVS, stock ticker CVS, currently trading at $85.57 per share. We can see over the past year, they're down about 21.79%. And over the past month, they are down 6.19%. So let's go ahead and jump over to our spreadsheet and see if we can find the intrinsic value of this company. So we'll come up here, plug in CVS and hit enter. And again, all of this data will load in. And you can see the price action over the last 365 days has been a little bit choppy, but again, right at that 52-week low, as you can see. If we come over here and look at the dividend data, they're currently paying out $2.42 per share, which gives them a starting dividend yield of about 2.83%, but a dangerously high payout ratio at 89.6%. Let's go ahead and jump over to Seeking Alpha again, and we'll look at that dividend history. We can see they only have 1 year of consecutive dividend growth, and if we scroll down and look at the past 10 years, we can't see back in 2013 they were paying out 23 cents per share quarterly. That's now 61 cents per share quarterly. So overall, that's pretty solid dividend growth. But from 2017 to 2021, they didn't increase their dividend payments any. So if you invested around this time period, you really haven't seen a whole lot of dividend growth. To me, that's not a very good sign. Let's go ahead and jump back over to our spreadsheet. We can see analysts currently have a target price of $116 per share, institutional ownership around 80.7, and a beta of 0.67. Let's go ahead and jump over to our first valuation, which will be Graham's valuation. I'll zoom in, and we can see all the variables that we plugged into our formula here: the earnings per share, our growth rate projection, and the current yield on AAA corporate bonds. And when we plug all this in, we come to an intrinsic value of just $30.70 per share. A large part of this is because of the low earnings per share for this company. But let's go ahead and jump over and look at our discounted cash flow model. And again, I plugged in the historical free cash flow for the company, which is honestly pretty good. But when you look at growth rate projections moving forward, it's not nearly as high as it has been in the past. So moving forward, I'm projecting a growth rate of just 3% to the future free cash flows for the company and the terminal value. I then found the present value of those future free cash flows, added them together, added the company's cash, and subtracted out their total debt to get their equity value. I then divided by the shares outstanding, and I came to a discounted cash flow price per share of $138.38. So a really strong discounted cash flow valuation when you compare it to the current trading price for the company. Moving forward, let's jump over to our multiples valuation. You can see the comparable companies that I used right here. Again, we take their stock price, divide by the earnings per share to get that price to earnings multiple. We then take the average price to earnings multiple for these company and multiply it by CVS's earnings per share, and we come to an intrinsic value again pretty low at just $35.28 per share. And if we jump over to our stock screener, we can see CVS's price to earnings is very high at 36.35. Now you could argue that they have a pretty large market share, which could somewhat justify their large price to earnings multiple, but to me it is a little bit of a red flag how much higher it is than these comparable companies. Now, I also didn't use Walgreens in this scenario, and I'll go ahead and plug in and show you why. If I hit enter here, you can see they actually have a negative price to earnings multiple at this time. which makes it really hard to use this valuation model. Let's go ahead and move forward and look at our last valuation, the dividend discount model. And again, we already talked about it. We didn't see a whole lot of dividend growth during this time period here, but the last couple of years has seen decent dividend growth at around 10%. So moving forward, I'm projecting a dividend growth rate of just 3%, fairly low due to the slowing free cash flow growth that we talked about earlier and the already high payout ratio like we saw. So jumping over to our dividend discount model, the discount rate at 9%, we come to a dividend discount model price per share of $41.54. So when we jump over to our output tab, we can see our 4 valuations. And yes, discounted cash flow is a little bit of an outlier. They produce a lot of free cash flow, but I do have concerns about the growth for this company in the future and concerns about the dividend growth, which is why we got low valuations for the dividend discount, multiples, and grams. So when we average these 3 together, we do come to an intrinsic value of just $61.48. And so with a 20% margin of safety, it's definitely way outside of our acceptable buy range, meaning it now is not necessarily a good time to buy this stock. This is a great example of a company that just because it's close to that 52-week low doesn't necessarily mean that it is trading on a discount. This is definitely not a company that I'm going to be considering in the future. I want to see growing free cash flow and growing dividend growth from any company that I invest in, and CVS really doesn't fall into that category. So there you go. Those are 3 companies that are currently near a 52-week low. One of them I have already bought, one of them I'm considering buying, and one of them I am staying away from. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. Seeking Alpha is also running a 50% off sale at my link in the description. So with that being said, thank you guys so much for watching the video, and please don't forget to like and subscribe to the channel.